Well, let's move on and talk to our market master of the day, Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, is joining us now. Mihir, good morning. It's good times and great tidings, right? Interestingly, the global environment is not that great, but India is outperforming in a big way. Do you reckon that this could be the order of the next few months? And what do you do at a time like this? Do you put fresh money to work, or would you wait for some of these global events like the Fed meet to play out?
Hi, good morning, Sonia. You're right. India has done extremely well. In fact, a bit scary, especially given the currency strength that rupee has demonstrated versus the other currencies, which is kind of also making me a bit worried about the trade deficit. So I think the broad theme is that the Indian domestic consumption story in the last few months has been very robust. And we are seeing a lot of traction in the consumption-linked themes, whether it's the opening up trades or the discretionary consumptions or even FMCG now to some extent. So I think the domestic economy is very strong, both on the goods consumption side as well as the services consumption side. And that's leading to a good amount of positivity in the local investor sentiment. The overall global macro, of course, as you mentioned correctly, is not supporting us, and that's what makes me a little bit worried, especially given the current state of valuations.
Okay, fair point. Well, the market is still holding, but as I said, because you're so close to some resistance, that there might be some profit taking. But just look at some other stocks. Shree Cement is once again your top gainer, 2.5% higher on that. Mihir, good morning. We've seen a massive run in cement stocks in the last 10-15 days. It's a bit of a deja vu. When the domestic economy stocks start to move. But are you buying any of the cement stocks at current price? Of course, there was this big deal as well of Adani buying Ambuja and ACC. The sector itself has sort of got its mojo back off late. But any views here?
So cement is always a sector which, surprises on the upside whenever people start talking negative about it. And that's because ultimately there is a bit of, there's a lot of supply discipline in the sector, which they have demonstrated over a long period of time. And it's one of the very pure local segments, I would say, purely local sectors with supply discipline. So that's how, whenever there's a bit of positivity on the local economy, the domestic economy, cement does tend to do well. But it's also supported by some good anecdotal data points. We have seen that real estate has been doing very well, especially on the urban demand side. We have seen pockets of demand coming back in Bombay, etc. Bangalore, Hyderabad, anyway, have been doing well. So I think real estate doing well. Government spending on infra likely to continue, and the fact that people are looking for probably pure domestic plays rather than a mix of local and global. So cement fits in nicely with that.
Okay, banks is really the place to be, right, Mihir? I mean, as we speak, most banks are sitting at fresh highs. SBI, ICICI, Bank of Baroda, even something like a Yes Bank has now been moving up. Wanted to ask you, do you feel it's a bit of a crowded trade right now, especially this private banking space, or do you see this as some sort of a structural up move?
I don't think it's crowded yet because the banks have moved, of course, in the last couple of years, but they are still not outperforming vis-a-vis the pre-pandemic levels. So I think banks underperformed quite a lot from 2020 to 2021, and I think it's only catching up. And if you compare the valuations of the sector, both private as well as public sector banks, they are not really crossing the previous highs. So there is some valuation support there.
That's on the banks. What about IT, Mihir? Because that is where we have seen at least one pocket which is still in a bear market. While the other stocks have moved on, IT index is still 28% from its highs. Of course, it had a massive bull market before that, so have to put it in context. But still, your view on large cap IT?
So I think it's the mirror image of what we just talked about, which is the banking sector. While banks underperformed, the global sectors like IT outperformed massively in the last couple of years. And now that we have the Western economies probably having seen the best of the stimulus, best of the corporate spending, there is a good chance of demand continuing to do well, but not as well as we've seen in the last couple of years. I'm talking about corporate demand for IT services. So all the pent up spending that companies had to do, or extra spending that companies had to do to enable high volumes of streaming traffic, high volumes of online shopping, high volumes of work from home requirements for connectivity, etc. So all that spending which was forced due to the pandemic has been done in the last couple of years. So maybe the robustness of demand will continue, but not to that extent. And valuations having moved up by almost double 2 to 3 times in the last 20 to 30 months makes a case for some amount of consolidation of IT. So I think it's a global sector, and the markets are playing the local sentiment as of now.
Hi, Mir. Good to hear your thoughts as always. What do you do with auto? Those stocks have done phenomenally well. The rebound in demand, cooling off of RM costs, supply side issues getting sorted out. But at these levels, what do you do? Some of them are sitting at fresh 52-week highs.
Yes, Nigel, but again, we must step back and, like we did in banking, step back and see where the auto stocks are compared to pre-pandemic levels. So if you look at the car demand, the two-wheeler demand, it is still, barely coming back to the pre-pandemic level. So there should be some steam left, even as far as demand is concerned. And of course, the other tailwinds like raw material prices and semiconductor issues, hopefully are behind us, which makes for a, further potential drivers in the next few quarters.
But overall, Mihir, what are you feeling about this market now? Because, there is one view that this market could just see outsized gains purely because of what's happening globally, right? But then we are also possibly heading into a global recession. So it's kind of a binary situation right now. How are you feeling about it? Is it good to deploy all the money in one go now, expecting that big boost? Or do you think that over the next few months, perhaps you need to take a bit of a cautious call?
So first of all, let me be very clear. Compared to pre-pandemic levels or pre-pandemic situation, the Indian long-term structural story actually has become much stronger. So there is no two questions about it. The China Plus One, Atmanirbharta, defense manufacturing, and the robustness of the local demand, in spite of government not doing much on stimulus, has really surprised global investors. And I think the Indian story and the Indian visibility has become much better than 2 to 3 years back. So that I don't think is a question at all. But as you rightly pointed out, there are short-term headwinds. Europe is going through hell. There is no way they can avoid a recession. The kind of stimulus or the kind of subsidies that they have to dole out for just energy is mind-boggling. So to that extent, 1/3 of the global economy going through hell. The other biggest economy, which is China, is also going through big problems. Exports are sluggish, which they need to grow. And their real estate sector, which is the largest segment, is also going through very, very bad times. So Europe, China, which are large components of the global economy, are likely to not show any good news for the next few months. And the Fed, ECB are very, very hawkish at this point in time. So I think there are huge global, headwinds for the global markets, and that's what makes me a bit worried for India also. While the domestic story, short term as well as the long term, is quite robust, but I'm not too sure how the global flows will pan out.
Okay, so in that context, are you worried about the recent moves in the broader market? I mean, the market's already trading at a much higher premium to its emerging market peers than it has in the past. And within that, now a lot of individual mid-cap and small caps, we are seeing a bit of an exuberance.
Yes, I would be cautious, at least at this point in time. Though, as we mentioned, if you look at individual segments like we talked about, say banking, like we talked about, say auto, their valuations don't look that expensive. Though the market as a whole is trading a bit higher than average valuations because of some of the other segments, but valuations are not that expensive. But I'm just quite worried about the global situation. And if you see suddenly a big bout of risk off, then that can be a headwind for the market in the short term.
Okay, all right. Mir, very fact that the globe and parts of the globe are going to go into recession, case in point being Europe, the metal index is a strict no-no. Some of those metal stocks, they could have a near-term tailwind, because of the shutdown of capacities. But China is still in a very, very sticky spot. So would you rule them out despite their balance sheets being in much better shape than it's been, say, in the last decade or so?
So I think the bigger driver is China because in the global scheme of things, Europe, whether it's aluminum or steel, does not really matter much as far as the shutdown in capacity is concerned. So what we need to focus is on China. And there actually they have been, while of course as we discussed there is a slowdown, but they are also managing the supply side quite effectively. So they may not let the prices crash beyond a below a certain level, and since they have the largest capacities in any case, I think you may not see the kind of lows that you saw, say, pre-pandemic or during the pandemic, etc. So I think it's kind of a neutral kind of situation as far as the supply demand is concerned.
Okay, I know we've discussed banks, but I do want your thoughts particularly on PSU banks, because at the moment there are some cyclical tailwinds that are playing out, right? Stronger asset quality, improving growth, stable operating performance, and we are seeing it in stocks like SBI. Do you just stick to the larger PSU banks, or now do you look beneath the surface as well?
We are sticking to the top couple of banks only in the PSU space, because while valuations are attractive, they are equally attractive even on the private sector side. So it's not a very clear case of going all out on PSUs for valuations only, because even the private sector has good valuations to offer.